Hello everyone, welcome to the Stock Trading Tutor channel. If you'd like to create a free Demat account with Alice Blue, click the link in the description and fill out your details. You'll also get intraday recommendation calls and you can learn robo trading software for free. Now, let's look at short coverings. Now, what is a short covering? Short covering is a buying back borrowed securities in order to close an open short position. It refers to the purchase of the exact same security that was initially sold short, since the short sale process involved borrowing the security and selling it in the market. So, let's look at the short covering cycle. First is the opportunity. An investor sees an opportunity that the price of a given stock in the market will soon fall. So the investor borrows shares of the company at the current price, and before the stock prices deteriorate to losses, the investor sells off the shares. The incubating period in which the investor must wait for the stock prices to drop before closing a short position is known as the waiting period. Now, once the stocks drop below the speculated margin, the investor buys back the exact number of shares borrowed. This is called closing a short position. In the previous phase, there are two things happening in the market. One, the stock prices may fall as anticipated. The outcome will naturally lead to profits since the trader will exit the position shorter and lower. The difference between the entry and the exit is the profit. So let's look at short covering versus short squeezing. First, let's look at rush to open versus the rush to close. In short covering, traders rush to open short position to make profits, while in short squeezing, traders rush to exit before making more losses. Next, in short covering, traders buy to cover, while in short squeezing, traders sell to close their short positions. In short covering, a trader sees an opportunity for profits, while in short squeezing, a trader's investment is facing threats. Let's look at the limitations of the short covering. Short squeezing leads to losses. However, a trader can determine whether an investment will result in profit or losses. It is done by evaluating the proportion of the shares sold versus total outstanding shares. The percentage is known as shares short interest. The other measure is the short interest ratio, which is the proportion of the shares sold versus the volume of the daily traded stocks. Let's see an example for short covering. Suppose you sold short 100 shares of the XYZ company at $20 per share based on your view that the shares were headed lower. When XYZ declines to $15, you buy back 100 shares of XYZ in the market to cover your short position and pocket a gross profit of $500 from your short trade. This process is known as short covering. Thank you for watching this video. For more videos on stock market and trading, please subscribe to this channel. If you'd like to create a free Demat account with Alice Blue, click the link in the description and fill out your details. You'll also get intraday recommendation calls and you can learn robo trading software for free.